and welcome to this month's Trade Floor Update. Today I'm joined by Portfolio Manager Aditya Thakur. Aditya, in September, the RBA increased and extended their term funding facility for banks. What is the TFF and what are the implications for investors?
So the TFF, or the Term Funding Facility, enables authorised deposit-taking institutions, or the banks, to access a very cheap funding directly from the RBA. So currently they can borrow for up to 3 years at a rate of 25 basis points. And the amount that they can borrow is based on a proportion of their current credit outstandings. But also they're able to access additional funding based on new lending activity that they do. And the scheme incentivises banks to specifically lend to small and medium-sized businesses, or SMEs. So to date, the banks have borrowed about $80 billion from the RBA under this scheme, but there's actually scope for them to borrow a further $120 billion by the middle of next year. So the point of the TFF is to lower the bank's cost of funding and therefore hope that they pass that on in the form of lower lending rates and lower mortgage rates to businesses and households. So it's a tremendous expansion of the RBA's balance sheet aimed at increasing credit to the economy and hence growth and investment. Now, in terms of implications for investors in particular, we see two key takeaways from the TFF, and we think it's somewhat underappreciated in the market. So firstly, as the banks can access this very cheap form of funding, they no longer need to pay up high rates for deposit rates or TD rates. So we've seen those rates come lower. In fact, TD rates and deposit rates are now well below the rate of inflation. So those investors sitting on cash are actually earning a negative real return and losing purchasing power over time. So that's one key important aspect. Secondly, we think that because the banks can access this cheap form of funding, they no longer need to issue a lot of debt. So credit spreads on bank corporate paper have come down dramatically. They're actually below pre-COVID levels. And the kind of secondary impact of this is that it's having this kind of gravitational pull lower on other similar high quality credit. So when we put these two things together, a need for investors to push out of cash and search for yield, and this kind of stabilising impact on corporate credit spreads, we think that both of these things together just further strengthens the case for high quality credit.
The government has recently handed down their 2020-2021 budget. What are your observations of this budget, and more broadly, what do you see as the role of fiscal policy moving forward?
So maybe I'll answer the last part of that question first. The role of fiscal policy is really to support growth as the economy transitions towards a private sector-led recovery. Now, this budget that was announced obviously was very large deficit at $214 billion for FY 2021, or 11% of GDP, and net debt to GDP rising to around 44%, but well below other developed markets. So whilst that might be a bit of a headline sticker shock for many people, I should mention a few things. First and foremost, the markets are very forward-looking and embedded expectations of a budget of this magnitude. When we look at interest rates and yields on government bonds, they were pretty much unchanged after the budget and have been stable since. Secondly, the AOFM, which is the institution responsible for raising funds on behalf of the government, they've been issuing debt at an average weekly pace of around $8 billion, which more than accommodates a budget of this size. And lastly, I would mention that the rating agencies have all reaffirmed Australia's AAA rating as long as we make way on reducing the fiscal deficit beyond 2022. So from an investor point of view, there's nothing to worry about in terms of the market reaction. And from a growth point of view, we think that it's going to be highly supportive of growth next year and underwrite growth. And then coming back to the points made earlier, we think that that should give investors enough confidence to move out of cash, out of the risk spectrum, into other things like high quality bonds and high quality credit in the effort to earn a little bit of extra yield, preserve capital, preserve their purchasing power and earn some income.
Well, thank you very much, Adidia. As always, we really appreciate your insights. And thank you very much for listening today. If you have any questions, please do reach out to your PIMCO account manager.